Welcome, everyone. Thank you very much to Sagar and Derek, our co-presidents of Mississauga, for organizing this with Cynthia. Aboud is Senior Vice President at Accord and a valued and long-standing member of our board of the M&A Club Advisory Board. And of course, Kevin Westfall from Accord, who's the co-president in Kitchener-Waterloo. So I'll have a few remarks to say later about the M&A Club and how we're running things. But it's a pleasure now to introduce Sagar, who's with National Bank and also a longstanding, as I say, with Derek, co-president of Mississauga. And he started Mississauga, I don't know, several years ago. It's going very well. And the beat goes on. So thank you, Sagar, and thank you, Derek.
So as Brian mentioned, both myself and Derek run the Mississauga chapter for the M&A Club. This is now, as Brian mentioned, so this is starting our third year running this club together. And it's been a great journey with lots of great speakers and great attendees and guests that we've had the honor to work with. As Brian mentioned, I'm with National Bank. I'm in their mid-market commercial team working on business transfer and cash flow deals up to about $10 million. After which we work with our partners over in our national accounts and corporate finance teams to look at transactions that are a bit more complex or larger in deal size than the 10 million range. I'm going to hand it over to Derek to give you a quick little breakdown about Loopster Nixon, and then we'll jump into our presentation.
Thanks. Derek Van Dorn, my partner and head of the corporate commercial group here at Loopster Nixon, a 55 lawyer firm principally operating out of the West End of Toronto. We have a downtown office that no one goes to anymore because of COVID, but it's there, and offices in Vaughan and New York City and Buffalo. We are a full service business law firm with a finance team, that processes transactions for banks and for other lenders. Large M&A transactional group, labor and employment group, litigation group, and every other area of business. And we're, to echo what Sagar said, we've been a long-standing member of M&A Club, and it's been great for me and for the firm, and we look to continue to build with everyone that participates.
Awesome, thank you, Derek. So to our feature presentation and speakers this afternoon, I'm going to give a quick introduction to both Kevin and Cynthia, both with Accord Financial, as Brian mentioned. So Kevin is a known and trusted product expert in the asset-based lending, factoring, and trade finance and purchase order financing space. For more than 20 years, he's been working with clients and advisors to structure creative financing solutions. They appreciate his ability to quickly understand their unique situations, looking beyond the numbers to understand the real story behind them. Kevin is active within many industry associations, including the Association for Corporate Growth and Turnaround Management Association. He's a member of the board of the International Factoring Association and is co-president, as Brian mentioned, of the Kitchener-Waterloo chapter of the M&A Club. When he is instructing creative financing solutions, he can be found in a hockey rink or on a baseball diamond coaching one of his three children's teams. Kevin is a graduate of York University with a degree in economics. And then alongside Kevin today, we're going to have Cynthia, who came to Accord Financial in 1999 with a diverse background working in manufacturing and service companies, as well as experience in conventional lending. Her skills and dedication helped escalate her to her current key role as senior member of the Accord Financial Inc.'s management team. She's an active part of the financial community with her continuous involvement in many associations that bring together professionals of the industry, such as Turnaround Management Association and the M&A Club. She often speaks on such topics as asset-based lending in the context of restructuring and M&A in locations across the country. For several years, she has been a judge at the prestigious John Molson School of Business International M&A Case Competition. Outside of work, Cynthia is a team player in her women's soccer league. She is the mother of two and can see her on the ski slopes during the cold Quebec winters. Cynthia holds a BCom from Concordia University and an MBA from McGill. So let's please welcome Kevin and Cynthia, and I'll turn the floor over to you guys.
Thanks for that nice introduction and kind words, Edgar, and to Bram and Lorene for providing this platform. like Sagar and Derek, we've enjoyed a strong relationship with M&A Club. It's been a great opportunity for us to network and really kind of just connect with people within the industry. So kind of without further ado, I'm happy to get started. So you probably heard some of the backdrop just before we got started about some changes in the economy and kind of where things are pent up with respect to potential insolvencies and some kind of the downfall of where things are headed. So in the next couple of slides, we'll kind of just glance over and then we'll kind of get right into some of the details. Lorena, if you could advance to the next slide, please. So kind of just an overview of the discussion we'll have today. We'll talk about some of the economic shock and the recovery challenges that'll come with that. We'll tell you a little bit about us and some of our lending products. And then we'll get into some of the BCAP program, which would be a little more interesting than given the current climate. Next slide, please. So, we've all been and seen the economic numbers and figures, and we've had a couple of economic updates through the M&A Club, so we won't get into too much details here. Just wanted to provide some of the statistics that are provided by Statistics Canada, EDC, and some of our partners and so on. Really just to say that we've had the deepest and fastest recession since the Great Depression, and it had huge dips in 2019 into 2020, and started to see some recovery, and then a little bit of fall off with a second wave, so to speak. Next slide, please. The recovery side has kind of been the growing debate. I guess we've expected to see some fallout sooner, but there's been significant stimulus money available in the system. So things like BCAP, like payroll subsidy, rent subsidy, and so on. A lot of the government programs have helped prolong. And I mean, we've been the benefit of that too with our clients, and our clients have benefited from some of those capital programs. And so, it's kind of on the good side and the bad side, I guess, for us from a, existing client portfolio standpoint and a new business standpoint. But we definitely see some kind of pent up demand and where it's going to see some fallout in the economy. Next slide. This is kind of taken right from EDC's, what we call CERT, the Canadian Economic Recovery Tracker. And it's really kind of just showing as of December how far off the economy had fallen pre-COVID to post-COVID. And so we're kind of on that road to recovery. The second wave has kind of slowed things down, and we'll see how things kind of continue to progress. Next slide. Some of the challenges kind of that we've been going through, what we're going to start to see is that, companies that, and some companies have done better than others. So I'll kind of put that caveat in that, we've seen clients in food service and other areas that have done quite well. We've seen clients in retail and other spaces that have not done so well. Those that were a little bit more challenged and able to survive, they're going to have burned through a lot of the capital on their balance sheet. So they're burning equity and so on just to survive and kind of get through. And then, what is their balance sheet going to look like as recovery kind of starts to return to normal? And then what solutions are going to be available to them? I've been talking to some in the banking world, and I think the banks are going to be a little more forgiving in having some of that burn through capital, but I think there's going to be others that are not going to be in the same situation.
Okay, so thanks, Kevin. I'm just going to give a brief overview of who Accord is. Hopefully most of you, if Kevin and I are doing our jobs right, most of you know who we are. That doesn't mean we stay the same all the time. The company was founded in 1978 as a very basic factor, a finance factor and a old line factor. And over the years, we've expanded to do ABL. We've made a lot of acquisitions. So we have coverage from Montreal, Toronto, Vancouver, California, South Carolina, and Chicago. So we really, not only we increased products, we increased our geographic reach. But one of the key aspects is that our type of financing is non-dilutive. So when you get in with Accord, you keep your equity, you don't dilute your holdings. So although Accord is a public, next slide, Lavin, please. So although Accord is public, we have not lost the entrepreneurial edge. We still work as if, even though we're public, we still work as if this is our money, some of it is, and we try very hard to be fast and flexible and give the entrepreneurs what they need as quickly as they need it. So as I said, we have 6 offices across Canada. We've been public since 1992, a little bit before I got there. And the head office for us is Montreal and Toronto for our group. So Montreal and Toronto, Kevin and I cover the country basically from Montreal and Toronto. Next slide. So among the solutions we offer our customers is factoring, buy the receivable, finance the receivable, PO financing, pure ABL lending, no covenants, that kind of real ABL. And now, since last year, we've been issuing BCAP loans. Next slide. So overview, we go from 500,000 to 20 million. That's our range. And we do have clients who are above 20 after they've grown with us. But I would say our sweet spot is really 1 to 9 million. Over 10, when we do a deal that's over 10, because we're not competing with the banks, we are usually in there because we're fast and flexible, because we don't match price. We don't offer bank rates, and we can't. Factoring can be with or without notification, advances up to 90% of the value of the receivables, no covenants, no ratios, and we approve based on the value of the receivables. We don't do an in-depth viability analysis to make sure the company is around. We look, is the receivable good? Is it collectible? In this factoring program, which really concentrates on the smaller ones, but we can go up to 20 million, we're going to disperse within 2 weeks. We're going to offer an automatic overdraft. We're going to give an inventory line of up to 500,000, open term, and no setup fee. So this is really our newest. We've always done factoring, but this is a new twist to it to help companies that need the money now. And as we've seen over the last year, sometimes things happen now, not tomorrow. Next slide. So I'll give you an example of a home furnishing products. It's a $1 million facility, full notification. Customers pay us 85%. We advance them 85% on their accounts receivable. We can go from 75 to 90. And we gave them a $250,000 inventory facility, and we dispersed it in 10 days from the timing of the term sheet. This has been a client since 2019. So this is just an example of how that works. Next slide. And up to Kevin.
So PO financing is kind of one of the more sought after products, especially as we've kind of come through, a pandemic and positioning changes from businesses. So I'll give you an example of one of our clients that was a retailer in shoes and accessories has moved into PPE and masks and gloves and so on. And so PO financing has really kind of played a key element for it. There's often a misnomer of PO financing versus production financing. So I'll kind of help, outline the two. For us, we really define PO financing as financing pre-sold finished goods. So you're an importer, distributor, you're adding very little value as the client. You're really kind of just importing goods and reselling, so to speak. And you've got an underlying PO, which is the element of it. You can't bring in, inventory. I mean, we have inventory facilities for that, but with PO financing, we obviously peg it towards a specific PO. We often get inquiries about, I've got a PO and I need working capital for soft costs like payroll, in other areas, which unfortunately we can't provide. That's more production type finance. I think there are a few people that can provide production finance, but we kind of specifically stay to PO financing. So just some of the rundown is that we can advance up to 90% of the cost of the items. So we generally want our client to have some skin in the game, so to speak. So they'll kind of finance the balance of the 10%. As I mentioned, we're financing for finished goods. The goods have to be pre-sold under a PO. And we generally require an inspection of the goods wherever they're coming from. So obviously a lot of work in Asia and China and offshore and so on. Some businesses I've kind of had discussions that, we've got our own inspection people there on the ground or whatever the case may be. And we typically need third party. So like an SGS or Asian inspection or somebody that's going to provide a certificate to kind of just certify the goods, if you will. So on the next slide, we'll kind of go over an example that we had provided a $1 million facility. In this particular case, we issued a documentary letter of credit to the supplier. It doesn't always have to be the case. So it could be a wire transfer and so on. One element that didn't get covered is that we generally can't finance deposits. So when you're working with customers and suppliers that require like a 30% deposit and 70% balance payment, we won't take the risk on the 30% deposit. There are just too many moving parts and things that could go wrong. And right now, kind of into Chinese New Year, and that, you know, creates shutdowns and so on. So it becomes with timing issues. Other times you have quality issues and so on. So there's two ways that we can manage it. One is that we can do the entire balance by documentary letter of credit, or two, if our client's willing to finance the deposit, we can finance the balance payment once the goods are ready to be shipped. In this case, we issued the documentary letter of credit, and it was basically for the 100% of the value of the goods. The inspection was undertaken by SGS. In this case, the goods were shipped directly to our client's customer. It doesn't have to be the case. We have, you know, some clients that need to break bulk. So for example, maybe you've got 5 POs for the underlying goods that are coming in, and you bring them back into your warehouse, you know, break bulk, repackage and ship sort of thing. And, you know, we would have no issues with that. And then every PO financing facility is really coupled with a factoring facility or an AR financing facility. So essentially the way that we get repaid from PO financing is for you to obviously build the goods to your customer. We would advance on the receivables and hold back any amounts that we've already provided to your supplier's PO. Then we give the client the working balance, or the balance for working capital. And in this case, it's been a client since 2020.
So one of our most active areas is in asset-based lending. I touched on that before. Our facilities start at 1 million and go to 20. So we have a little niche there because a lot of asset-based lenders will not go below 10. A couple of the ABL banks will, but and some of the US companies will, but we have a kind of almost like a protected zone in the smaller areas. What we finance under ABL is receivables. So it acts like a line of credit, it's a revolver. Advances, again, up to 90%, no covenants, no ratios. We do inventory revolvers. So how we determine what a company can access on their inventory, if they have POs and finished goods, it's almost an automatic approval for 75% of cost. And if they don't, then we have inventory appraised if it's above 400,000 or 500,000. Under 4 or 5, as a facility, will appraise in-house and get a desktop. But once it starts to become a significant amount of raw material, work in process, and finished goods, we'll bring in a professional appraiser in, and we'll finance 75% or more of the net orderly liquidation value. When it comes to machinery and equipment, it's over a term, but it's still a demand loan. And there we'll also finance 75 to 80% of the NOLV as determined by an appraiser that we use or that we can get comfortable with. We don't use appraisers to make us feel good. We use appraisers to say, here, this is what you'll get. Then we decide, you know what, it's worthwhile deal. We'll advance a little more, but we're selective with the appraisers we use. And in there, the terms are up to 48 months, principal and interest payments. So it's and occasionally, and the reason we don't write it down is because it is occasionally, if a company has some equity, maybe behind another bank or something on a building, we may throw a few $100,000 at it, but we don't do owner-occupied main real estate. So sometimes we can use it to add to the package, but it's not something that we look at as a standalone basis. Next slide, please. So here was a really fun example of a deal we did in 2019. We had a very large kitchen cabinet manufacturer that just couldn't make it. They were great at sales, less so administration. They invested in a plant that was based on future orders from a company who was honoring them until they had a product recall because of a death of a toddler. So they lost, they had upsized and they just didn't have the sales to maintain it. So we had a client who was in related home businesses, but not in the cabinet. And he had the wherewithal, financial, administrative, and the will to acquire this company. So we lent them out of bankruptcy, stalking horse bid. So we worked with the trustee and we gave him $14 million against receivables, inventory, and equipment. We gave him 90% of the receivables and OLV, like we discussed, 75% on the other assets. What was really key about this, and this is where in the M&A context, whether it's in distressed or regular, we financed this file in 13 days from the signing of the term sheet, which is, you know, time was running out for the acquirer and therefore also for the company itself. So by working quickly and putting everybody on board, we were able to save the company, save a bunch of jobs, and the company's doing very well. Next slide, please. So we have certain specialties, high growth, highly seasonal, where you need more money than, company might need more money than their equity would provide in a conventional. Early stage, M&A, we do manage and leverage buyouts. We do a lot of restructuring and turnarounds. And we think this year we're going to be combining the M&A with the turnarounds, and distressed and out of favor industries. We're not doing fashion retail now, even though it's an out of favor industry, but we don't make one judgment based, we don't judge a company by the industry it's in. We'll look at the company on its own.
Yeah, lockdown tough. Okay. Lockdowns have made it tough on the retail side right now, just because they have no sales primarily.
Yeah. Okay, Kevin, you want to take over?
Yeah, I mean, kind of touching on some of our industry expertise. We're fairly agnostic, but I guess kind of just related because of our ability to finance up and down the balance sheet. We can get involved with manufacturing companies looking for leverage on receivables, inventory, machinery, and equipment, and so on. Same thing with wholesale and distribution, with PO financing and dealing with goods and so on that, you know, requires a level of AR finance. Have the ability to manage all of those facets, then just seem to be tied towards those sides. Not to say that we can't work with service businesses like you know, trucking, staffing, consulting, and so on. We previously had pretty significant holdings in the retail space, and you know, just given the retail landscape right now, have slowed things down there a little bit. But as Cynthia mentioned, we're not completely adverse. We just need to understand the story and where they're going. So food and beverage, import, export. We have a so to speak, so it's kind of within the context of our ABL. The business credit availability program. So, you know, Cynthia it kind of saw early on that there was the program is going to be available, and she took the initiative and kind of got the management team together and reached out to EDC to see what our approval would be, and we ended up executing a relationship and an agreement with EDC. So I guess most are familiar with the BCAP program, but for those who aren't, the federal government is guaranteeing up to 80% of loans. So most of the banks obviously have BCAP availability. I think to date we might be the only non-bank lender that was approved to provide BCAP guarantees on our loans. So we kind of have two facets of it: the regular kind of ABL space up to 6.25. We've also developed kind of a smaller platform for loans up to $250,000. So that's kind of what we'll get into today. So it's to say that we can provide BCAP on larger ABL type facilities, but have been focusing more on kind of the smaller end of the market for loans up to $250,000. Next slide, please. So we've called that $250,000 loan program Accord Express. So think about it like a merchant style loan. We like to actually think about it more like a BDC type working capital loan, where, you know, personal credit scores and commercial credit scores are going to kind of come into the mix. So kind of, I won't get into all of the lines of detail here, but, you know, it's an online application process. The process takes about 20 minutes or less, and you'll have funding in your account within 3 business days, you know, if you qualify. So some of the key items there are that the terms are 36 to 48 months. So it provides some pretty significant flexibility. And the interest payments are kind of baked in for the first 6, if you will. So you'll have no kind of cash outflows for the first 6 months. And then you'll kind of start principal and interest payments after month 6. And the loans can be prepaid early at any time without any penalties. And you must be located in Canada, been affected by COVID, and some of the other items that are noted down below. And each of the loans in this case have to be supported by a personal guarantee. Not necessarily always the case, but generally the case. Next slide, please. So what the funds can be used for is kind of general operating expenses, whether it's inventory and increasing sales or just meeting rent, financial obligations, and so on. or if you need to kind of take on, new equipment or anything to kind of deal with growth, so to speak. What it can't be used for is to repay or refinance any existing indebtedness. So it has to be a new loan, and it can't be used to pay off an existing loan. And of course, it can't be used to pay out management bonuses and dividends and so on along the lines to the principals of the business to bonus out. Next slide. And then just some of the examples and some of the transaction announcements that you might have seen. I mean, on the smallest end, I think we've seen loans at about 35,000.
Yeah.
Ranged up to 250,000 on the Accord Express program. Fairly industry agnostic. So I kind of wanted to include some in here with, those in the construction business. In this case, there was a restaurant operator. There was also kind of movie studios and related industry in there. So it's kind of almost anything and everything. We've been working with other secured lenders as well. So other, smaller asset-based lenders, even those with bank facilities and so on, are taking on this program. It's we generally aren't requiring any sort of corporate security. So we're not registering GSAs and PPSAs. We're generally working in concert with other lenders on this program. So other lenders have been kind of using it as a working capital tool for some of their clients.
Kevin, can I just make a comment
For sure.
before we close up? So as Kevin mentioned, we go from 25 or 35,000 to 20 million. We have clients whose sales are probably a couple $100,000 a year to 150 million a year. And just so it's clear, we have expertise in these that we access across North America with the various offices. So our Chicago office specializes in larger equipment financing, and they can do Canada, US. We can do Canada, US. So we have expertise, and all the offices can work together and inter-refer. So if you have a cross-border transaction, I had someone call me this year, a Quebec company wanted to buy a company in Ohio. I worked with our South Carolina office to get it done. So it's really, we work together and we try to do it for the benefit of the client. That's it.
Thank you, Cynthia and Kevin. So we will open the floor for any questions. There's a couple already on here, so we'll go through those. And if anybody has any questions, please feel free to use the chat or the Q&A or raise hand function, and Lorene will allow you into the conversation from the raise hand function. So there's a point here from Amashika with EDC. EDC can consider financing production costs if the company is exporting. So just a point for all of our listeners. And now there's a question from Zolt. Are there any plans to expand offering to the new highly affected sector lending program, HASCAP?
So I'll try and answer to that. There's been no plans for HASCAP yet. When it first was discussed, and please correct me if I'm wrong, it was some of the highly affected sectors were tourism and restaurants and other industries like that, which we don't finance generally anyway. And one of the basic tenets of most of these programs is that it has to be something you would do ordinarily. You don't do it just based on a guarantee. It's a good point, and I will inform myself more as to the affected industries. Kevin, I don't know if you know any more than that.
No, I mean, so obviously kind of through our other BCAP side, we've been financing some of those affected industries, again, retail, restaurants, and so on, but nothing directly through HASCAP as yet. And I don't know where the discussions are internally with HASCAP.
But thanks for the hint. I'm going to do it this afternoon.
That's right.
So basically, stay tuned to be continued.
Yes.
Bram, it looks like Bram has a question.
Yeah, I just wanted to mention we have an upcoming webinar, not to take anything away from this presentation, which is, of course, so important and interesting. But BDC will be in the Toronto office. They've started a unit, I think it's a year now, which is for IP financing, which is new for them. And there's an upcoming webinar in March for that. But I had a question for Cynthia, or a comment. Why don't you tell us, Cynthia, about that famous story, I think it was 2 years ago, where you got a deal done 3 weeks before Christmas. It was a $10 million deal and it couldn't be done but actually you got it done.
Yeah, it was, and I can tell you who it is because they've given us permission to use them as references. So Sears, when Sears was being liquidated, they had a transport company called SGS. No, SLH.
SLH.
Sorry. SLH. So we had a
Sears.
company, a client, a large transport company who was with us. They restructured, they went to a bank. So when they had the opportunity to buy this company, they had 3 weeks to get it done. They called their bank. Their bank is very much in favor of the company. They have a great relationship, but the bank on December 1st could not promise to disperse by December 21st. So they called us, and it was all hands on deck. And we managed to put the deal through so that our ex-client became a client and was able to make that transaction. And just on closing, they paid. They stayed with us for a year. That was the deal. If we make this happen, you stay with us for a year. And like, it was a tremendous, tremendous acquisition. And we've done a couple of more for that particular company when other acquisitions have come his way. So, 3 weeks is, I mean, that's we don't like the 3 week ones, but we'll do them. We'll do them because we can. So we'd like 4 weeks better, but
Wasn't that, Cynthia, wasn't the deal that if it couldn't be done, the company would have gone out of business?
Not our company. Well, no, they would have just sold off.
Yeah, they would have lost the opportunity to another bidder, so to speak.
Yeah,
They had the right bid. They just need to be able to secure the financing within that time frame.
yeah. And the one that I talked about, the furniture manufacturer, the cabinet manufacturer, they would have just closed if they didn't have our financing for that. They were on the way to close, and I mean, there was hundreds of employees, hundreds that would have been in the regions of Quebec. So it's not even, it would have been a very trying time for the people there. But I see. Kevin, maybe you want to take Callum's question.
Yep, there's a couple more questions there, so we can.
Yeah, for sure. Fire away.
So alternative finance is relatively unknown in Canada versus the traditional banks. What are the panel's views on how we get the message out to SMEs that there are other options?
It's really kind of just situations and taking on opportunities like this. It's really kind of just networking at its finest and building it. We'd never really, as an association, gone out to, and I say association like the IFA or others. It's difficult to go out and kind of do widespread marketing or advertising in general media, newspapers, television, and so on, just because of the cost and expense sort of thing. So I think the best advice that I've been able to kind of give is just really kind of just networking and so on. And, what I often find is that there might be opportunities for us that aren't necessarily fit, but there could be other, alternative lenders. And we always do our best to kind of, partner or find solutions and so on. I know I've worked with Sagar on some opportunities and Derek and others and so on, where it's not a fit for us, but they know somebody else and vice versa. And it really kind of just networking at its finest. But unfortunately, that's the best solution I think that I can offer on how to kind of just get the message out there, is just continue to network and tell people, who you are, what you do.
And I think just to echo that from a bank's perspective, I mean, that's how we learn about the solutions offered by Kevin and Cynthia and Accord, and how we're able to also suggest them to clients as well, where there's maybe a better fit on the platforms or solutions they offer versus what the bank can do.
So for someone for a company like ours, as opposed to a PNC or a Wells Fargo or a bank that has an alternative lending ABL department, we have smaller budgets. So a lot of it is, as Kevin described, we're moving into, as we grow, we're moving into the press releases and more marketing that's not just me and Kevin telling everybody how wonderful we are. We also use our clients because nothing works better than a client who has tried it and likes it and will give us a reference or give us a testimonial that we put on our website. But I've been doing this for since 1999, as we said before, and I have seen a huge difference and when I started, even the CAs didn't know what factoring an ABL was unless they were categorically in the market. So there's been a lot. There's been a lot of improvement, a lot of increase in the awareness, and that's as Sagar said, you just keep pounding it out, and at some point a good story will repeat.
From my perspective, I mean, the traditional lenders have kind of come to understand that we're not a competitive offering. If anything, we kind of work in concert. So on those early stage companies, for example, that just don't qualify for bank financing, they might come to somebody like Sagar and say, listen, I need, financing for X and Y, and you've only got one turn on your balance sheet and not enough history to be able to provide a solution where we can kind of just take a look at the underlying assets and say, we can provide a solution. And we're really just incubating those opportunities for the bank and getting to that stage. And using that acquisition of SLH as the example, they already had a bank facility. They needed funding within 3 weeks. They took $10 million from us within that 3-week period and then graduated back to the bank once the bank was able to kind of review the information, get it together, and so on. So, generally what we do is either on an open term, 1-year term, so on. So it's all short term, with the aim to graduate back to the bank.
One thing I did forget to mention in the factoring, which Kevin, you just reminded me, our factoring program, because it's open, we also will do spot financing. So I think, Sagar, you guys have a factoring program, but a lot of the banks don't. So if a bank finds itself where it has unused liquidity and receivables or inventory, we can step in and work with a bank. I forgot to mention that spot when I was talking about factoring.
Absolutely. So a couple of questions here from Amashika with EDC.
Mhm.
Have you seen a large increase in demand for companies looking to finance abnormally large purchase orders for PPE? And the second, I'll just ask them both at the same time because the second one's a little more straightforward as well. Do you often win business away from banks because you are able to turn it around faster?
Which one do you want, Kevin?
POP. Listen, if I had $1 for every PPE deal I saw,
For 30 million in one delivery.
I wouldn't be living in the snow that I'm living in right now, for sure. So yeah, for sure. For sure. I mean, so I know we kind of talked about pre-sold. I guess another key element of the PO financing side is history. So we look for, the key element in underwriting for us is proof of concept. We're not financing first transactions. We're not a venture capital or private equity type situation where, I've got this PO, it's going to be great, I need financing. You need to be able to demonstrate that you can fulfill on that order. Acquiring the goods or the products and so on is the easy element of the transaction. So finding a supplier and so on. There's a lot involved with international logistics, with customs and so on. So there's so many issues that could happen of getting products from offshore into Canada through customs and into your customers' hands. And so without some of that underlying experience, we would kind of step back. Wait for you to, finance probably your first couple of transactions, show us that you've got that track record and you're able to execute on those opportunities. And so we are really then financing growth. We're not financing the startup stage, we're financing the growth element.
Yeah,
So
both the Quebec.
Side,
sorry.
no,
Kevin,
just on that side that we haven't been able to finance a lot of the PPE stuff because people just don't have the experience in importing and distributing and so on. But so it's been a challenge there.
Yeah. The Quebec and the Ontario governments it was almost like they were throwing purchase orders against the wall to see what would stick. We got some calls where people who had never seen a mask before March in their life and had no clue what a mask was, got these $30 million purchase orders from a hospital or a medical system, and it was to all be delivered on the same day. Like the risk involved, like how do you inspect it? How do you just, we had to say no. And we're still saying no to those monstrous ones, but now some of them are coming in, $1 million of sales a month where it's more regular and it's not, we can't even issue a purchase order for like the 20 million you need for a $30 million show. And many of them were not putting up any money. They thought they would get 100% financing because they had a PO. And it was absolutely a messica. It was absolutely ridiculous.
Out of the second question, I don't know that we ever really win the business from the banks. I mean, I think we'd be the first to admit that, every company needs some form of bank financing at some stage.
Yeah.
And we're really here to help support, their goals and objectives. So earlier stage companies that may not qualify for bank financing, in this particular case where it was just that acquisition that they needed a $10 million facility, within 3 weeks, which wouldn't be reasonable ask of, your traditional lender and so on. So I'd say we're kind of providing the bridge, where you are today to, where you could be at a later date, so to speak. I know it was a previous webinar that we were on about renewables that talk, Gretzky's got a great, quote of, go to where the puck's going to be, not where it is, so to speak. So we're happy to kind of finance, your balance sheet to where it could be, not necessarily where it is today. So yeah, I don't see us as competition for the bank in any sense.
No, we don't. The answer to that is not often enough. So sometimes it'll work. we can't compete on price. We can't compete on speed and service and flexibility. So if a company is growing and they know they're going to need more in X amount of time, then there's a reason. But you know, if a bank is, especially today with the rates are so low, if a bank is going to give the client what they need, we wait for the next one. You know, we know we're not in that game. So.
Kevin and Cynthia, can you speak to a little bit to your appetite on tech and biotech, sort of the, you know, I wouldn't say the VC level startup, but you know, as more of a startup scenario. What's the appetite for Accord for that type of industry and those type of clients?
They're generally asset-light companies, and
Yeah.
us being kind of asset-based lenders, so to speak. I mean, so you know, we're providing capital through the leverage of asset, regardless of the stage of your balance sheet. So we're not kind of constrained by capital and so on.
Yep.
So if they, you know, generally tech companies would have maybe receivables. The majority of their would either be goodwill or IP, which is difficult for us to provide leverage against. So those are, you know, more for cash flow lenders like you than, you know, for asset-based lenders like us. So those are more challenging businesses for us. And many of them actually bill in advance. So I'm going to develop something for you or create a product for you. And it's generally difficult for us to finance receivables billed in advance, only because the product or service hasn't been delivered yet. And generally our client's balance sheet is not the strongest, so to speak. So there's an execution risk then of our client being able to deliver.
I spoke to a tech-ish company yesterday. They build systems. So one of their divisions sells hardware. The hardware is delivered, and it's billed and paid. They also do work where they build a system. So the deposit we don't touch. Then there's the next 20%, but the last 50%, which is the final invoice, sometimes we can actually do it. But it's like, I can't do the middle part. We can't do the middle part because the asset is in the engineer's brain, and we haven't figured out how to how to monetize that yet. So the idea is that whatever's the final invoice of the project or a hardware component, if it's a separate PO, you know, sometimes we can be creative. But as Kevin said, like it's tough because you have these monstrous investments, sales of $1 million, loss of 30 million, and the receivables start to trickle up. But you know, we talk to people, and often it can't be done.
So it doesn't look like we have any further questions. I'm going to turn it over to Lorene to kind of share with our listeners what to expect in terms of the follow-up email. But before I do that, just a quick note that on next month on March the 18th will be our next webinar for the Mississauga chapter, where we will have Canadian Business Growth Fund, or some folks known as CBGF, will be our presenter for that webinar. Thank you, Cynthia and Kevin, for the insight on both the market and some of the solutions you guys are offering given the current environment. I think, you know, just there's different institutions providing solutions in this market that are required to help our companies, the Canadian companies, get through both the growth and the challenges that they're facing. So thank you for sharing.
Thanks for the opportunity.
Yeah, we have some very interesting sort of new subjects that we're trying to offer besides the usual. We have the head of Darryl Bricker, who's the head of Ipsos, used to be Ipsos Reid, the big Canadian polling company, on Canadian attitudes, demographics, immigration, investment. It's really interesting information. Actually, we had quite a long talk. He was telling me all about his new book. And this is one of the leaders in Canada for telling us really, I guess, about the future, about the present and about the future, a lot of things that we don't realize. That's coming up. We have, as I said, the IP financing, which is a whole new area for BDC coming up. And we have others. There'll be, Blake's will be giving us probably in April, a review of their M&A stats and metrics, which they do every year for us, which are also hugely interesting. Both Canada, US, focus on Canada, because they're either, depending on the year, number 1 or 2 for the number of transactions they do as a law firm. And we have an investment in Asia webinar coming up. Anyway, lots of other interesting things, so stay tuned. The M&A Connect, which is for members only, which is a virtual roundtable we do once a month. The deal listing that we offer members, and members obviously are using it. It's 40 pages now, and I think it's more than 40 pages. We've exceeded that. That's every 2 weeks it goes out. We have a new website coming possibly even next week. We've been working on it a very long time, as you can imagine. And that's an entirely new website, and there'll be new offerings for members to connect with each other. I won't go into detail, but there's a lot of exciting stuff going on. So thank you very much. Thank you, Cynthia, and thank you, Kevin, for this really interesting, you know, I guess, expose of your area, which is obviously terribly important in all the financial options that firms have. I always say, too bad for me in the family business. I had no idea, you know, it's like a typical entrepreneur. Once you're finished with your house and your grandmother and your family and your bank, it's sort of, I guess I'm out of options. That's the end of the road. And of course, there's so many, especially today, there's so many other options, and it's great to hear about this, which is very, very important. And as you said, you've saved, you know, a lot of companies. I happen to know a couple myself that Accord has really saved. So save the company, save the jobs, you know, in the industry. So thank you very much, everybody, and we'll be speaking with you soon again. And thanks, Sagar and Derek, for organizing this.
Thanks, everyone.
Stay safe, everyone.
Thanks, you too. Take care.